Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Mark and Phil hanging out talking investing, finance, and retirement. This week we're going to play Fact or Fiction, which is incredibly hard to do with a financial advisor because their go-to answer is it depends.
It depends.
What's going on, Phil? How are you?
I'm doing great. Enjoying spring.
We've got a coating of green everywhere, and yet, you know, you're coughing or sneezing and people are looking at you still funny.
I know. That's the challenge in the time we live in is like, no, seriously, it's just allergies. Trust me, I get it every year.
There's green everywhere. Right?
That's right.
Film of it on the car. So,
yep.
Pretty funny stuff for sure. We got a message in, Phil, that said that we should do a drinking game sometime, that every time you say run the numbers, that we should take a shot. It's like, that can make for a fun show.
Oh, yeah. But it'd get kind of interesting by the end of the show for sure.
It would be interesting, yeah. But you know what? It's such a true statement. And this fact or fiction game is, easily sets that up. I joke to say it depends, because when you're talking with an advisor about anything financially related, everybody, there's universal truths that affect us all, right?
Right.
And we talk about that often, but then that specific universal truth does have a wide range of the details that affect you differently than me, and so on and so forth.
Yep, absolutely. And it just like you said, it depends on your specific scenario. I mean, the facts are the facts. They don't change, and we'll talk about those here, but how those facts apply to your scenario is a little different because everyone's scenario is a little bit different, and what the makeup of income and assets and, all that comes together.
So we're going to play fact or fiction. Do your best to give me one or the other if you can, although it's really going to be in the wording of the statement.
Yes.
And that's it's like the fine print. If you think about when you're looking at a brochure or something like that, some sort of a sales thing, a lot of times it's in the fine print. So fact or fiction, your Social Security can be taxable.
And that is a fact.
Okay.
It technically is taxable.
Okay.
How much of it is taxable really depends on the makeup of all your income and amount of income. I mean, not to get too deep in the weeds, but there's a whole separate calculation. And this is always one of those confusing parts in helping clients understand it. But it can be anywhere between 0 and 85% taxable.
The top.
Yeah, it doesn't get more than 80, at least now. I mean, now that's always subject to change, but yeah, so 85% of the benefit is taxable at whatever your rate is.
Okay.
That's the other misconception or confusing piece there is it's not an 85% tax rate. I always joke and say that the government's greedy, but they're not that greedy, right? So they're not going to take 85% of the benefit, but it's subject to tax at whatever your income rate is, as your income goes up. So
how many people actually realize that when they come in and talk with you?
I mean, it's more and more that realize it. Yeah, I mean, it's still, and when we teach Social Security classes, it's still one of those things that people are like, what? I didn't think, you get a few of them out there.
Okay.
I mean, the reality was when FDR first put it in place, his new deal, it was not taxable. I mean, it was specifically written in Social Security law that it was not a taxable benefit.
Right.
But it didn't take long after his administration was out for the new administration to bring it in and start out at, up to 50%. Then it went up to 85%, so.
Always looking for ways to get some extra money to pay some of these bills we got.
Always. And unfortunately, with everything that's gone on recently, I don't think it's going to change.
Okay, so technically, fact, your Social Security can be taxable.
Yep.
Fact or fiction, your taxes will likely be lower in retirement.
I mean, I would say fact. I mean, it is likely. If you're looking at all taxes, yes, because when you're working, you're paying Social Security and Medicare. In addition to the federal and state, so your total tax burden definitely is higher. That you don't pay Social Security and Medicare when you're retired. And I mean, unless you work,
right.
But your Social Security benefits, pensions, any monies out of IRA, interest, dividends, things like that, typical retirement type income is not subject to Social Security and Medicare.
Okay.
So if you look at it that way, then definitely your taxes are lower. Your income tax component, though, maybe not.
Okay, that's what I was going to ask you. I was going to say, so from that standpoint, it sounds a little bit more a fact, but what we've been saying for a while now is it's, if you're talking about just your when you go to see your CPA and you do your taxes annually, are you
Right.
in the same tax bracket or a lower tax bracket? Often we're not seeing that be the case. So I was thinking this one really could be a fact or fiction. Again, it's in the
Right.
wording a little bit.
Yeah, I mean, it's always the devil's in the details, so to speak, right? I
Very
mean,
true.
look at it at a high level. Taxes, yes, taxes will be lower because you don't have Social Security and Medicare. That's a big tax burden.
Yeah, and
You know,
they kicked that one up as Social Security up. So yeah,
yeah, and that keeps going up each year. So,
right.
but the reality for most retirees is no, their income tax burden, even if tax rates stay the same, is likely to go up, especially if you've done a good job saving.
Yeah,
If you
because
start adding up the numbers of if you've got a pension, if you've got Social Security, and you've saved for retirement, start looking at all those retirement streams of income coming in, especially when RMDs hit,
I
and
was going to say, and
it,
you run the
it, it
real
can be
risk.
a surprise.
Yeah.
Yeah.
You run the real risk of kicking that up a notch if you're not efficient and have a good strategy in place for you pulling those RMDs, getting that money out of the 401k that you've been pumping into or whatever. You run the real risk of kicking yourself up a notch too. So,
Right.
yeah. All right.
And I mean, the big danger in here too is looking beyond the first spouse to pass for a surviving spouse, because
Yeah.
then taxes, I mean, almost inevitably go up just because of how the tax brackets work.
It seems like most of the time people forget, and it's totally understandable that we forget this, but you've been married and you've been filing, married whatever for
Joint for
30, 40 years.
Yep.
And when you lose a spouse, you're back to filing single.
Right.
Most people tend to forget that, which again, it's understandable, but
Yeah. I mean, it's not something you really want to look at, but it's, in our line of work, it's something we look at all the time, and it's a big part of the plan that we want to help clients understand. Here's the reality. I mean, this is just how it happens.
Right.
Let's plan today to prevent that potential tax burden for a surviving spouse.
Well, and that's really one of the reasons, among many others, that you would turn to a professional to help you, so you don't have to think about it.
Right.
I've been thinking, I've been married, filing what I've been doing for 40 years. I'm not going to be, I just lost my spouse. Yeah, I'm going to be in a higher tax bracket.
Mm-hmm.
Nobody thinks that way, right? So that's why you have an advisor. Yeah. That's why you have a team there, helping you with, elder law and so on and so forth.
All the different, all the different pieces. I hear it all the time that when clients really start looking at all the pieces, they're like, I had no idea this was that complex. I thought it was just a matter of, I put my notice in, I'm retired, and now, okay, I start taking money out of my IRA and I'm good.
I'm good. Yeah.
I said, that's one version. You can try that,
Sure,
but you have no control. You're just kind of running with the wind, so to speak, and whatever happens. So
try to be more efficient. That's the idea, right? I mean, you could just pull money out of your 401k or whatever, but that confuses a lot of people too. We'll do that on another show, another day.
Yeah.
All right, let's keep moving along. Fact or fiction?
Sure.
Again, it's in the details here. Term life insurance is better than whole life insurance. This seems kind of hard to answer.
Well, I was going to say, whenever you hear better, there's nothing that's better all the time, right? I mean, you've got to look at term and whole life. I'll call it cash value. So that, just as a general concept, because whole life is one version of a cash value policy, meaning it's a policy that has an investment component for a better term of how it works, that's building this cash value through retirement that helps support the cost of life insurance. So is term better than cash value? It depends on your scenario.
Is there an age thing with that? I think a lot of times we hear term when we're for a certain age, and then whole when we're different. Does that factor in?
I mean, yes and no. It comes down to, I guess, what you're trying to target. I mean, term is really good at specific timelines, right? I mean, you have to think of term, you're renting the policy, so to speak, right?
Sure,
so it's yours for whatever that term was, whatever your lease was with that policy.
Right.
So if you have a very specific time frame you want to cover, so for younger people that are looking to, okay, I've just got my first mortgage, it's a 30-year mortgage, and I want to make sure that my spouse has money to pay it off or whatever if something happens to me, or kids in college or things of that nature, then term might be a better fit for at least a part of it, because it's a very defined that once this happens, that need is gone.
Right. Okay.
Once the kids are out of school, well, you really don't need that anymore because you've already funded it.
I'll let you get away with that one on It Depends, but of course it depends on all of these. So fact or fiction, Medicare will cover most of your medical needs in retirement. Tricky.
Well, I guess it depends on what you call most, right? I mean, if you're most being more than 50%, then could be the fact, I mean,
Okay.
it kind of depends on what your total medical bills are.
Maybe a better term would
So
be basic. Medicare will cover most of your basic medical needs in retirement, right? Because I mean, it covers your doctor's visits, it covers a hospital visit, things of that nature.
yeah.
But there's
So I mean,
no dental. There's no, the eye
right,
is very limited. My mom had cataract surgery. They picked up a portion of it.
right. Yeah,
Uh,
I mean, it has to be a medically necessary cataracts. They still call that,
right.
but general eye care, dental, none of that
Right. Yeah.
qualifies, and that's
Eye
often
exams,
surprising,
like that.
especially
Oh, yeah.
if you work for a company that's had that. I mean, you're walking into retirement thinking, what? I don't have, dental and vision
Right.
anymore. So,
Right. Yeah.
at the
Uh,
time, you probably are going to need more of it than you have in the past.
True.
But
Yeah. And then, of course, you start talking about all the supplements, Part D and so on and so forth.
right.
And so what constitutes, I guess, again, maybe basic needs is maybe that's a good way of thinking about it. Yes, Medicare is a great program in a lot of ways
Mhm.
for a lot of the basic needs.
Yeah, and again, it's understanding the what is Medicare, and Medicare, the government benefit, A and B, hospitalization, doctor, outpatient type
That's
services.
the two, yeah.
The government benefit covers a lot, but there's a lot of gaps in deductibles and copays, and
Right.
so the easiest piece to understand is Part B, the outpatient doctor type.
Mhm.
I mean, that policy is an 80-20 policy. Just Medicare AB by itself, I'd call it for sure fiction. I mean,
Yeah.
if you layer in then supplemental plans, it can cover. I mean, you can get some really
You can
good
get some good
supplemental
stuff,
plans
but
that
you're
it covers
forced
everything.
for it. Yeah.
You know,
It's going to
and
cost. Yeah.
it's going to cost you, but it's a lot of times in comparison to what you might be
True.
used to in retirement, it might be less.
True.
Or I mean, your working years. So.
And hopefully you're budgeting and factoring in for that. We've talked about
Yeah.
COLAs before, and the fact that
Yep.
occasionally Social Security gets a COLA, but it's usually eaten up by the Medicare offset,
Mhm.
So on and so forth. But one thing that is definitely not on there is long-term care.
Yes. Yeah, and that's a whole nother gamut
Nada.
unfortunately Medicare doesn't cover.
Yeah.
There is some very short periods of time that it'll cover for what you might think of as a long-term care benefit, being in nursing home or something like that, but it has to be tied to a hospital stay. Usually it's rehab is what it comes down to. That's,
Right. Yeah.
you're had a knee replaced and you have to be discharged into a rehab, for a short period of time. So it covers a very short period of time that you're going to recover from. Yep.
And again, it all comes down to having a plan in place and figuring out, what do I need? Where am I self-funding? Where am I not? Long-term care options, all those different kinds of things. So worth certainly having conversations about all of these when we're talking about this. We're just having a little fun here with fact or fiction. But
Yeah.
again, you really want to dive in. And all of this stuff is going to be covered by, an advisor who's helping you plan for your retirement. You're going to kind of go through all of this.
Right.
Sure
Right.
that you, are not playing fact or fiction with these items. Hopefully.
And that's part of that comprehensive plan. If, like to your point, if you're not touching each one of these as you're looking at your retirement plan, there's holes. You're missing some pieces that need to be touched on.
If your advisor is not talking about these,
Right. So you yourself, if you're doing it, or if your advisor, if
Yeah.
they're only dealing with the investments and not talking to you about all these other pieces,
you got some gaps.
there's some gaps. Yeah. You need to really get a second opinion and make sure that you're covered.
Yep, exactly. One final one here, and then we'll wrap it up this week. Fact or fiction, Phil, as we get older, we should gradually shift from stocks to bonds.
I would say with that, I'll call it fact, and the key word in there is shift, so it didn't say get out of stocks completely,
Okay.
and unfortunately that's sometimes,
Fair.
When people approach retirement, think of, I got to no risk anymore. I've got to be safe and secure. So put it in the bank. Well, okay. So especially in today's environment, that's great.
Yeah.
Your $1 million, like we've talked about before, might be still there tomorrow and worth $1,001 over the next year because you got paid $1 of interest on it. Your biggest danger there though is inflation.
Right,
so that's the other piece of the equation where the bond component probably isn't going to really help. You're going to need some stock exposure,
Right.
to help grow long term with inflation for a portion of the money.
But bonds right now typically this is an old
Yep.
traditional kind of setup for a portfolio because there was less risk typically in bonds. Is that the case in today's market, Phil? Because bonds do seem to be a bit volatile as well.
Yeah, not at all the case today. So that's yeah, this is again, always looking at kind of rules of thumb or concepts out there. Yeah, that bond being the more conservative investment, and compared to stocks, absolutely. It's still, even in today's environment, I would consider it more conservative than a bond or a stock.
Mm-hmm. Right.
But there's way more risk built into bonds today than was even 10 years ago.
Okay.
Or
Right.
15 years ago, as we've gone through these other financial crises, because we're at the bottom of the barrel, so to speak, with interest rates. I mean, it doesn't get a whole lot lower than where we're at today.
Yeah. Very true.
And as interest rates start to rise, your value of the bonds are going to start to decline. So you have to keep that in mind, that value of the bond is going to end up going down if you sell it. Now, if you hold it to maturity, you'll get the principal back. But,
right. Maybe we should have done, as we get older, we should gradually shift from stocks to more risk, less risk, kinds of products. Maybe
yeah.
That a better way to put it.
Yeah, I mean, stocks and bonds are the general concept that most people kind of relate to, but at the end of the day, this whole question to me really comes down to understanding risk. So number one, what are you comfortable with? What is your tolerance?
That's a big factor.
But then when that's in play, okay, well, how do you position it? And that to me is how we help clients. Once we've done a plan, we understand the cash flow and when you're going to need the money and how much. Now let's look at the investment component. Let's put together a plan of how we can make your money last, grow with inflation, positioning risk such that it's not going to harm you while you're spending it, but yet still giving you the opportunity to help keep up with that inflation long term. So
absolutely. Well, how did you do with fact or fiction, folks? Did you have any of those right? Did you were you off? Did you agree with some of Phil's assessments, whatever the case might be? If so, reach out, have a conversation with him. If you need to have a chat about what's going on with you, if you're a little worried about, what Medicare will or won't cover, or if you're worried about, Social Security and it's taxable and all those kinds of things that we talked about, give him a jingle at 248-888-7530, 248-888-7530. As always, it's one of those things where we bring to you different concepts on the show, hopefully provide a useful nugget or two of information, but it always comes down to your unique situation, and you should always check with a qualified professional before you take any action on anything you hear on our show or any others financially related. So give Phil or any advisor a call, but make sure you're talking with somebody before you take any action. Of course, Phil has been doing this a very long time. He's a CPA and a personal financial specialist at AFS Wealth Management. And again, you can call him at 248-888-7530 or check us out online at philstaxhacks.com. That's philstaxhacks.com. Phil, I'll see you next time, my friend.
All right. Have a good week.
Have a great week, and we'll do it again next time here on the program. Don't forget to hit subscribe on Apple, iHeart, Stitcher, Google, YouTube,
all of the above.
All of the above. But we'll catch you later on Phil's Tax Hacks and Other Retirement Facts.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.